The US-Iran conflict could reshape the global economy. And this time, it's not just about politics. It's not just about military power. It's about something much deeper. Energy, money, and control over the global system. Right now, tensions are rising again. Oil markets are reacting. Investors are watching closely. Governments are preparing behind the scenes. But here's what most people don't realize. This isn't just another geopolitical conflict. It's an economic pressure point. That could trigger a chain reaction across the entire world. And by the end of this video, you'll understand exactly how this conflict could spread far beyond the Middle East, and why it could impact everything from inflation, to jobs, to global stability. So how does a conflict between two countries turn into a global economic event? How does tension in one region translate into inflation, market crashes, and recession risks worldwide? And more importantly, are we already seeing the early stages of this happening? To understand this, we need to go deeper. Because this story didn't start today. The relationship between the United States and Iran has been shaped by decades of tension, sanctions, economic pressure, political conflict. For years, Iran has faced restrictions from the global financial system, limited access to international banking, reduced ability to export oil freely, economic isolation from Western markets. And yet, despite these pressures, Iran remains one of the most strategically important countries in the global economy. Because beneath its territory lies one of the largest reserves of oil and natural gas in the world. And in today's world, energy is everything. Oil fuels transportation, gas powers industries, energy drives production. Without it, the global economy slows down. Now here's where things become critical. A large portion of the world's oil supply doesn't just come from the ground. It must travel. And one of the most important routes it travels through is the Strait of Hormuz, a narrow passage between Iran and its neighboring countries. Every single day, roughly 20% of the world's oil supply passes through this one location. Think about that for a moment. One narrow waterway, controlling a fifth of global energy supply. Now imagine what happens if that route is disrupted. Even slightly. Oil supply tightens. Prices surge. Markets react instantly. Because oil markets are extremely sensitive. They don't wait for full disruptions. They react to risk. And when risk increases, prices move fast. This is how geopolitics enters the economy. Because when oil prices rise, inflation follows. And inflation is one of the most powerful forces in economics. When inflation rises, everything becomes more expensive. Fuel costs increase. Transportation becomes more expensive. Production costs rise. Businesses pass those costs on to consumers. Food prices increase. Energy bills rise. Daily living becomes more expensive. This is what we call an inflation shock. Now here's where things become even more complicated. Central banks are already under pressure. In many countries, inflation is still elevated. Interest rates are already high. Economic growth is slowing. Now introduce a war-driven oil shock, and the system becomes unstable. To fight inflation, central banks raise interest rates, but higher interest rates come with consequences. They slow down borrowing. They reduce spending. They limit investment. Businesses delay expansion. Consumers cut back on spending. Growth slows down. This is how economies begin to weaken. But here's the hidden vulnerability. The global economy today is heavily dependent on debt. The world is sitting on over $300 trillion in debt. Governments rely on borrowing. Corporations depend on financing. Households carry loans. When interest rates rise, debt becomes more expensive. Countries struggle to service obligations. Companies face refinancing pressure. Defaults begin to increase. This is where financial stress begins to spread. Now let's expand the picture. Financial markets don't operate in isolation. They react to expectations. When tensions rise between major geopolitical players, investors reassess risk. They move capital. They reduce exposure. They seek safety. stock markets become volatile, currencies fluctuate, bond yields shift rapidly, and this creates instability across the financial system. This is especially dangerous for emerging markets because these economies depend heavily on foreign capital stable currencies, affordable borrowing. When capital flows out, currencies weaken quickly. Debt becomes more expensive. Economic pressure increases. Now add another layer. Global trade. Trade depends on stable routes, predictable costs, efficient supply chains. War disrupts all three. Shipping routes become riskier. Insurance costs increase. Logistics slow down. This leads to delays, shortages, higher prices. Once again, inflation rises, and the cycle continues. Higher oil prices lead to higher inflation, which leads to higher interest rates, which leads to slower growth, which leads to financial stress. This cycle feeds on itself, and breaking it is extremely difficult. But here's the twist most people miss. The biggest risk is not always physical disruption. It's psychological reaction. Markets are driven by perception, expectations, fear. If investors believe oil supply could be disrupted, prices spike immediately, even if supply remains stable. This is what makes the system fragile, because perception alone can trigger economic consequences. Now combine that with existing global conditions. High debt, slowing growth, tight financial conditions, and you have a system under pressure. Oil becomes the catalyst, not the cause, but the trigger. So what happens next? If tensions continue to escalate, here's the likely chain reaction. Oil prices remain elevated. Inflation stays persistent. Central banks maintain high interest rates. Economic growth slows further. Debt pressure increases. Financial markets become unstable. Businesses begin to cut costs. Hiring slows. Unemployment begins to rise. Consumer spending weakens. Demand falls. And eventually, the global economy contracts. But not all countries will experience this equally. Energy importing nations will face the greatest pressure. Emerging economies will be the most vulnerable because they have less flexibility, less financial buffer, less ability to absorb shocks. But even advanced economies will feel the impact because in a globalized system, no one is fully insulated. But here's something important to understand. Every crisis creates opportunity. When markets fall, assets become undervalued. New trends emerge. Wealth shifts. Those who understand these cycles position themselves early. Because while most people react emotionally, a few think strategically. And that difference determines outcomes. The US-Iran conflict is not just a geopolitical story. It's an economic one. It's about energy, markets, and the stability of the global system. The question is no longer if there will be consequences. The real question is how far those consequences will spread, and whether you will be prepared when they do. If you want to understand the forces shaping the global economy, subscribe to Atlas Economics. Because the world is changing, and those who understand it will always stay ahead.